Hello, Business 201. This video describes the transactions from illustrative problem 1 on pages 25 through 28 of your textbooks, and it illustrates how these transactions affect the financial statements. If at this point you have not reviewed Learning Objective 1, the accounting equation, Learning Objective 3, the accounting equation and each element of the equation, Learning Objective 4, how business transactions affect the accounting equation, and Learning Objective 5, the financial statements that a business produces, please stop this video now and read the related sections of your chapter and watch the videos that you see here on this screen. If you've watched these videos, let's take a look at illustrative problem 1 on page 25. To accompany this illustrative problem, there is a spreadsheet that describes the financial statements. The balance sheet, shown here in yellow, that has the assets, the liabilities, and the equity components. The income statement, which shows the revenue and various expenses. And finally, the cash flow statement, which parallels the increases and decreases in a company's cash account. Also, this dynamic spreadsheet will automatically update the financial statements for each of the transactions that we will go over. For example, you can see that the beginning balance for the month of July has cash of $1,000, which is reflected in the balance sheet. Accounts receivable, $3,200, which is reflected in the balance sheet. And supplies, $850, which is reflected in the balance sheet. And the entire balance sheet gets its accounts from this spreadsheet that you see above. As we enter transactions, that balance sheet will be updated. Okay, let's run through the 11 transactions that we have. The first transaction, Cecil Jameson, attorney at law, received cash from clients of $3,928. Cash is an asset, and we will show an increase in cash by adding $3,928 to cash. And because Cecil Jameson performed services for his clients, he would have done all that he needed to do to earn revenue, so we will also increase fees earned. If fees earned are increased, that will increase his income, and income is part of earned capital, so the earned capital portion of the balance sheet also increases. What this transaction illustrates is that the income statement represents the detail of the increases, revenue, and the detail of the decreases, expenses, in the earned capital. One thing that you should assure that you always do is that if your income changes, that income will change the earned portion of owner's equity. Let's examine transaction B. Cecil Jameson paid creditors $1,055 on account. Since a payment was made, that payment will reduce cash, so enter a negative amount under the cash account. Creditors represent liabilities, and if a payment is made, that also reduces the accounts payable, the liability. Enter a negative amount into the accounts payable account. As we enter the transactions, you can see the account totals here are updated, and there is a check to assure that assets equal liabilities plus owner's equity. Additionally, notice how the income statement has been affected by the first transaction, and notice now that the balance sheet account, accounts payable, reflects the change that we just made from transaction B. In examining the cash accounts, the first transaction, which increased cash from billing customers, that will be classified as an operating activity, and payment of accounts payable will also be classified as an operating activity because receiving income and paying suppliers are a normal part of doing business. Let's examine transaction C. Cecil Jameson contributed or made an additional investment in the company $3,700. So the company's cash account would increase $3,700, but in this case no earnings took place because Cecil Jameson, the owner, contributed additional capital to the business. Because the change in assets, $3,700, equals the change in owner's equity, $3,700, the accounting equation balances, and we are complete with the financial effects of this transaction, with the exception of categorizing the cash flow. Because this is a receipt from Cecil Jameson, the owner, this is contributed capital as a financing source, and it will be classified as a financing source of cash. Let's look at transaction D. Cecil Jameson's business paid office rent $1,200. Because cash was paid, cash will be reduced $1,200, and we will show rent as a negative amount because expenses reduce earned capital and reduce net income. So the reduction or the expense account reduces net income, and because net income shows the change in earned capital, we will also enter a negative $1,200 under the earned capital category. Cash was paid, and we will show this as an operating cash flow because payment of rent is a normal business activity. Let's take a look at transaction E. Cecil Jameson charged but did not receive cash for legal services provided to his clients. So Cecil Jameson would have billed his clients, so that means an asset, accounts receivable, will be increased. Also, because Cecil Jameson rendered a service, he has earned his income, and so we will increase revenues $2,025. The increase in revenue brings about a like increase in income, and because income increased, the earned capital will increase $2,025. Now note, the balance sheet doesn't balance until I fully enter the $2,025 amount to the earned capital. Now, once that amount is entered, you can see assets equal liabilities plus owner's equity. Because cash was not received by the business, there will be no effect on cash flow for transaction E. Let's look at transaction F. Cecil Jameson's business purchases supplies on account $245. So the asset supplies would be increased, and because the supplies were purchased on account, meaning that Cecil Jameson's business promised to pay for them later, a liability account, accounts payable, will have been increased. No revenue or expense was incurred, and because there was no cash payment or cash receipt, the statement of cash flow is unaffected. Let's move to transaction G. In transaction G, Cecil Jameson's business received cash from clients on account $3,000. So the cash account for Cecil Jameson would increase, and because this was a payment on account, that means some of Cecil's clients paid him some of the $5,225 that would be owed to Cecil Jameson, so the accounts receivable account will decrease. After recording this transaction, the balance sheet balances, so we're done recording the elements of this transaction, with the exception of classifying it, and receiving cash from customers represents an operating activity. In transaction H, Cecil Jameson received a billing invoice for paralegal services from Legal Aid, Inc. The amount was $1,635. In this case, the legal services business would have provided services for Cecil Jameson, and Cecil Jameson has incurred an expense of $1,635. We will enter in a negative amount for expenses because expenses reduce income and expenses reduce earned capital. So the legal expense reduces income, and we should also show a commensurate decrease, $1,635, in equity. Whoops, the balance sheet does not balance, so there is another item that we should add to this, and that would be to accounts payable. This is a promise to pay later. A promise to pay later is a liability, so Cecil Jameson has incurred a liability of $1,635. Entering the liability causes the balance sheet equation to balance, so we are complete with this particular transaction. As a note, because there was no cash received or dispersed, there is no effect on cash flow. The remaining three transactions, in transaction I, Cecil Jameson paid wages expenses of $850, utilities expense of $325, answering service expense of $250, and miscellaneous expense of $75. The total of all those expenses amount to $1,500. Because Cecil Jameson paid these expenses, the cash account would have decreased by the total $1,500. The balance sheet doesn't balance, so there is one other element that we must include, and that would be the decrease in earned capital from the decrease in net income. Now the balance sheet balances. Because there was a reduction in cash, we must show a classification in the cash flow statement as an operating cash flow. Paying bills are part of doing business. In transaction J, determine that the cost of supplies on hand would be $980. As of this transaction, cash flows were cash supplies were $1,095. The amount left over would be $980, so this balance under the cash account should be $980, which means the difference between $1,095 and $980, $115, must have been the supplies that have been used up. So after entering that transaction, supplies show up at $980. An asset that is used up or a cost incurred is an expense, so we will also enter in a negative $115 under supplies expense to indicate the reduction in net income, and we will indicate a $115 decrease in earned capital to reflect the decrease in income. The balance sheet balances, and so this transaction is completed. As a note, no effect on cash account, so there's no effect on cash flow. And finally, in transaction K, Cecil Jameson withdrew $1,000 for his personal use. Reduced cash. In this case, Cecil Jameson made a draw of $1,000 from his business. The balance sheet balances, so we've accounted for this item, and because there was a cash reduction, we will show a minus $1,000 amount under cash. Because this was a withdrawal to the owner in compensation of the owner contributing money, we will consider this a financing transaction. Okay, we've accounted for all the transactions, And these column totals represent the balances that the financial statements must show. So let's just show how this works. Let's start with the income statement. We have revenues of $5,950 as fees earned, and then we will list individually these expenses for the business, show a total for the expenses, deduct the expenses from fees earned, and that produces the same net income, $1,053, that you see in your spreadsheet. Now, that net income will be transferred to the statement of owner's equity, $1,503. The beginning balance in owner's equity, as you see, is $1,350. The owner contribution to his business would be $3,700. So $3,700 is the contribution. The net income plus the owner contribution gives $5,203 as the total additions, less the withdrawals made during the period, $1,000, gives a net increase in equity of $4,203 when added to the beginning capital, produces an ending capital balance of $17,723. This ending capital amount is the amount that should appear on the income statement, $17,723. From here, we will accumulate the balance from cash, from accounts receivable, from supplies, from land, and add the total of these assets to accumulate to a total of $20,078, which equals the amount in our spreadsheet. And then for the liability side, we will bring down the $2,355, and we already have the balance from owner's equity, $17,723. The total of the liabilities in owner's equity amount to the same total as the total assets, $20,078. Okay, there you have it. What we have done is to show the effect of transactions on the balance sheet, income statement, and statement of cash flow, and use the balances from the column totals to create the income statement, statement of owner's equity, and balance sheet. Now, what you folks can do for your assignment, problem 1.1, is the same type of process, showing the effects of the transactions from problem 1.1 for Brett Eisen's business, accumulate totals, and show those totals in the financial statements. Give it a shot. Thank you.